Good afternoon. It's Dustin Raring with Highway One Capital. It's Tuesday, March 23rd. The market just closed 1 o'clock. Stocks kicked off the week on a really bright note yesterday with the S&P rallying big on the back of daily gains from all 11 major industry groups. Another potential off-ramp for the U.S.-Iran conflict drove the Monday rally after President Trump came out and stated that the U.S. and Iran had very productive discussions about a resolution, and that U.S. strikes on Iranian energy infrastructure would be halted for 5 days, and that was a big reprieve. A drop in crude prices buoyed sentiment and lifted treasuries, despite Iran coming out later and denying that the ceasefire talks took place. So the media, interestingly, was very mixed on whether Trump or Iran was telling the truth, but that really just highlights kind of the division that's going on right now in our nation. What we learned yesterday is that stocks really do want to go higher, but they do need an off-ramp. The Strait of Hormuz needs to be opened either through diplomacy, which is really what we're hoping for, or by force. But the Strait of Hormuz definitely needs to be reopened. Once that happens, we believe that stocks should go higher. Today, on the other hand, the U.S. markets gave some of yesterday's gains back, with the Dow off about 84 points, the S&P down 24, and the NASDAQ gave back 184 points. So clearly lots of uncertainty continuing to drive all the volatility in both the stock and the bond markets. An interesting note, our friends at PIMCO this morning, they highlighted the stagflation risks that are being associated with directly with the conflict and energy prices, with the potential for energy prices being elevated for much longer. And as all of you know, Tim and I have been tracking stagflation risk for quite some time. We've been in the camp that stagflation wasn't really a near-term risk to the portfolios, but clearly with the conflict and elevated energy prices, that brings that risk back on the table. So basically, it's rising inflation and a slowing economy. So oil at over $100 a barrel for a long period of time could clearly create that situation. So it's precisely why we haven't been taking much duration risk in our fixed income portfolios, and we're pretty happy that we haven't done that since interest rates have jumped up quite a bit here recently. Our long-term thesis is clearly that that stagflation isn't a significant near-term risk, but clearly a long drawn-out conflict with elevated prices could put that back on the table. So we agree with PIMCO on that. This scenario puts quite a bit of pressure, not that they didn't have it before, but clearly elevated pressure on the central banks, both domestically and abroad, to deliver for the economy. One of the positive developments that we really haven't heard much talk about, but as we look at all this volatility and this, the global, kind of panic that's been going on, is the resiliency of the U.S. dollar. And there was a lot of talk leading up to this that the U.S. dollar was at risk of losing its kind of safe haven status. And this has been a clear test as there's been a lot of stress in the global markets, and the dollar's rallied. So that's a really strong signal that the U.S. dollar continues to be a flight to safety play. So and we believe that the forces that support dollar appreciation are likely to remain intact. So we'll continue to provide market updates to all of you. As always, feel free to reach out if you'd like a deeper discussion, and hope you all have a wonderful day. Thank you.